Lowe's did come in with, just in terms of earnings per share, better than expected number, $4.67 versus the $4.58 that the street was expecting. That's what we saw from Home Depot yesterday, too. Pretty handy beat on that bottom line. But if you look at the revenue number, revenue came in below expectations, $27.5 billion versus the $28.1 billion the street had been expecting. And the comp store sales were actually down by 0.3%. That compares to expectations of a 2.1% increase and an increase yesterday at Home Depot of 6.5%. Yesterday, Lowe's shares were higher. I think they closed higher just as Home Depot did. At the beginning of the session, when people were looking at Home Depot's numbers, they were under some pressure. But in the afternoon, that stock picked up, and it closed up by about 4.3% at the end of the day. Let's take another look at what's been happening with Lowe's, because they are also giving some guidance for the quarter. And I'm just going through these numbers, but it looks like the business outlook right now. They are now expecting full year 2022 total and comp store sales towards the bottom end of the outlook range. They're expecting operating income and diluted earnings per share towards the top end of its outlook range. They say this reflects in the first half the sales performance and expectations for continued pro strength and improvement for do-it-yourself trends. But it also reflects the company's, what they say, disciplined expense management and benefits of productivity initiatives for coming through with some of these things. So they're now looking for total sales of $97 to $99 billion. And I'm just trying to look for the expectations for the full year. 97.5 is where the street is. So that kind of mirrors what we're seeing from them. Right. From street's expectations on this, they're looking for comp store sales anywhere from down 1% to an increase of 1%. Gross margin rate up slightly compared to the prior year. And interest expense, $1.1 to $1.2 billion. Total share repurchases, about $12 billion. Capital expenditures of about $2 billion. And I know we've got somebody here who can tell us what that all means, Andrew.
Absolutely. Let's bring in Brian Nagel to that conversation, Becky, because he's the senior equity research analyst at Oppenheimer, follows Lowe's, Home Depot regularly, has been with us for many, many years on these mornings. Brian, your top takeaway in terms of that headline?
Well, good morning. Look, I think, Becky, I think you summed it up well. I mean, as we always do, we're going to evaluate Lowe's relative to what Home Depot said. And on that balance, Lowe's is weaker. Now, it's not a bad report, okay, because what they're basically saying is that sales were tracked modestly shy of their expectations, but they were able to make that up to some expense controls and deliver earnings above expectations. But nonetheless, I mean, following yesterday's, I think really stellar results from Home Depot, these Lowe's results do look somewhat weaker.
So, look, the stock now, I'm looking at Lowe's, the stock's down about 17% on the year, obviously was much lower just two months ago. In terms of both Home Depot and Lowe's as a bellwether for where you think the consumer really is and where you think housing really is, what do you think it says?
Well, look, it's a great question, Andrew. And I think this says, and again, putting aside what I just said, some modest weakness in Lowe's today, I think if we step back, like you're saying, it's basically saying that consumers in good shape. So because here, and we really, again, stepping back, looking at Lowe's, so just say, to make it simple, say they did, roughly flat comp store sales here in the fiscal second quarter. I mean, that's coming on top of really substantial gains over the last 2-3 years now. So that, to me, that says this home improvement consumer is actually holding in quite well. And of course, this is happening, despite all these concerns about either a slower housing backdrop in the United States or slower spending generally. And you're just really not seeing that here with Lowe's.
Hey, Brian, just looking through the numbers, they're now saying that they see for the full year $13.10 to $13.60 in terms of earnings per share. I know the street, the consensus is at $13.39. Where were you?
We're right there in line with consensus. And just to be clear, that earnings guidance that Lowe's is talking about today is consistent with what they had said previously. So again, they're trimming top line guidance modestly by saying they're going to the low end of the range, but they're keeping that earnings guidance the same.
Right. The same-store sales outlook, I mean, that, again, compared to what we saw from Home Depot yesterday, is a little disappointing, I would guess. But maybe it's heartening to hear that they're going to make sure that they are really making sure they're paying attention to margins. What's more important?
Well, I mean, look, that's right. As analysts following retail stocks, I mean, we tend to look first and foremost at sales. Okay, so that's usually the best measure of health of a business. So again, that's weaker, but it says something. It says something that they can continue to maintain their margins. And as I've talked a lot in your show, I mean, CEO Marvin Ellison, joined now Lowe's a while ago, but he's done a phenomenal job of really repositioning this business. Lowe's today is a much better run company than it was pre-Marvin. And I think this is another testament, because again, also I want to just comment a bit on the sales of what's happening. So we talked about yesterday with Home Depot. Look, the weather, the weather's been really hot. Okay, so that's probably more of a negative for this DIY customer. The pro business has been strong. Home Depot's more skewed to pro. Lowe's is more skewed to DIY. So I say the backdrop is not quite as great for Lowe's, but the point I'm making is that Marvin is able, with his team, is able to really manage through these choppier sales.
Shepard Smith here. Thanks for watching CNBC on YouTube.